Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. Last week was the federal budget. A gentleman that I've interviewed before had the privilege of meeting the chief economist at the Credit Union of Central Alberta, Charles St-Arnaud, is back with us today. He's written a little bit about this budget, and I thought it'd be great to check in with him. I understand you were in Ottawa in the budget lockup, so that must have been fun. Tell us a little bit, Charles, about what you thought about this federal budget that came out last week.
Well, I think in some ways it was not necessarily any big surprise. A lot of the big announcements were kind of already leaked in the week prior to the release. I think where is some of the disappointment is when we start looking at the details is that one is the deficits are now expected to be bigger throughout the fiscal projection periods of between now and fiscal year 27-28. We also have a slightly bigger amount of debt because of that deficit. And where I'm a bit more concerned is that as much as last fall, the federal government was expecting to bring back a balanced budget by fiscal year 27, there's no plan now to bring back a surplus. So there seems to be a constant trend over the past year that the deficits are getting marginally bigger year after year. It's not big increases, but it's kind of a worrying trend, and it's starting to be a slippery slope.
You and I, when we chatted last, we were worried about high interest rates and inflation. Isn't this just going to fuel even higher inflation than it otherwise would be and force the Bank of Canada to raise interest rates even higher?
Yeah, well, the increase in spending is not massive. You're talking about $5 billion this year, $5 billion next year. So it's 0.1 percentage point of GDP. So it's not big spending. It's not something that will make a big difference, but it's not going in the direction, I would say in the best direction. If we were to see stable spending would be more what the Bank of Canada would want to see. And actually, the Bank of Canada has actually already expressed some concern on the level of spending. If we refer back to the minutes of their deliberation of their January meeting, they kind of hint at it, saying that government spending at the end of 2022 was stronger than potential growth and could be supporting domestic demand too much. So it's basically, in a nutshell, what they said. So they started to be a bit worried that there's too much government spending.
So what do you think? Is there too much government spending?
Well, I think we're in a situation where we don't necessarily need more government spending. I think that's where my disappointment is that as much as we needed a lot of government support during the pandemic, because obviously where we were in March, April 2020, and suddenly you have 1 million Canadians that suddenly lost their job because of government restrictions. It's the government's job to come in and help. So for 2020, 2021, there was a good economic case of supporting spending. But now in 2023, where the economy is relatively strong and the pandemic is well behind us, I don't think it's the time now to be spending more, especially as you mentioned. We also have to rein in inflation. So why add a bit more oil to that fire?
In the report that you issued after the budget, you said the lack of commitment to balancing the books and a wider deficit throughout the projection period is concerning, as it suggests that fiscal prudence may be slipping away.
Yeah.
Do you think that fiscal prudence is slipping away in our federal government?
Well, I think the issue is that it's a slippery slope, because you can always say, oh, I'm just adding a couple billions here. Oh, a couple of billions here. Yeah, it's a couple of billions every year, but over 10 years, it adds up to be a big amount. That's where I think is the issue. And the issue is, as much as it's that we need to have some kind of fiscal anchors. I'll give a good example. Just before the fiscal year to bring back some fiscal capacity to intervene when there's a negative shock. So if we go back to pre-pandemic, the government debt to GDP was about 30% or so of GDP. Now it's 40%. So it cost about 10% of GDP to support the economy. That, by the way, was roughly what we've done. Also, we had as an impact on the debt during the Great Financial Crisis between 2008 and 2014. government debt to GDP increased by also about 10% over that period because we needed to support the economy. Growth was weak, and fiscal policy can do more surgical intervention. Monetary policy is a blunt tool. You just lower interest rates and it will stimulate at large, or it will stimulate interest rate sensitive areas.
Right.
Well, fiscal policy can go and target specific area of the economy that actually needs help. So when you have a negative shock, a recession or a pandemic or a financial crisis, it's a tool that's much better adapted to get you out of the mess. But we need to have the capacity. So at 44% or so GDP in terms of debt at the moment, well, if you have a crisis tomorrow, that means that our debt in a couple of years from now is 50%. Gonna get step increase. And it's the cost of servicing that debt that gradually starts to eat up your revenues. Because that's another concern. If we compare, like right now, according to the latest budget, the government is spending about 10% of its revenues to pay the interest of the debt.
Right.
That means that for every dollar they get in, 10 cents goes to interest payment.
No, it's got to go up with interest rates going up.
Well, it includes the fact that interest rates have already increased. The question is how much higher will go. I don't think we'll go much higher than where we are at the moment. But it's still, the bigger the debt goes, the bigger that amount is. And that's money that could be better served into public services. So that's where the debt can be a bit of a problem, is that when you start gradually increasing the amount, and that was the issue we had in the 90s. In the early 90s, the government was spending about 35% of its revenues.
So you don't think we're at a situation comparable to the 90s yet, when Chrétien and Martin had to come in and dramatically cut spending because we had what some people called sort of a Canadian peso crisis? We're not there yet.
No, we're not there yet. That's for sure. But it's a slippery slope. It's easy to sleepwalk into the problem and not really address the problem now, because we also have some fiscal issues that will come in the future. We have an aging population. We have costs that are increasing everywhere. So we need to recognize that a lot of the costs that we have right now will increase in the future. But as a greater share of the population is in retirement, will also contribute less in terms of tax payment.
We're chatting tonight with Charles St-Arnaud, the chief economist at the Credit Union Central Alberta. We're going to take a break for some messages, and I apologize I interrupted you. We can continue with that thought when we're back in just 2 minutes. Stay with us, everyone. Our topic tonight, the federal budget. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. Our topic tonight is the federal budget that came out last week. Our guest is Charles St-Arnaud, who is the chief economist at the Credit Union of Central Alberta. In your report, Charles, you talked about for Alberta that the main focus will be on the measure to support investment to lower carbon emissions. You know, I think that some people thought that this, I think it was $20 billion investment in climate change industrial strategy, well, you know, was bragged about, but frankly, some people thought it was just a copy of what was happening in the United States and had to be done because of what Biden had done in the U.S. budgets. I guess what you're talking about here is that the support is for wind and solar energy and gas-fired plants with carbon capture, but you worry that it's not for carbon capture utilization and sequestration, things that Alberta might be interested in. Tell me what you think about this $20 billion. That's really almost industrial strategy. And I thought industrial strategy in the past hadn't worked in Canada.
Well, it's industrial strategy in a specific way. It's not, we're not picking up winner and losers. That's the thing. We're actually offering tax credit to investment to promote private investors to come and invest in those sectors that will be needed in the next 20 years. It's well documented that Canada needs about $100 billion in investment in green energy. $100 billion,
and this is 20 million?
Well, that's 20 billion that they're doing, that the Canadian government is providing through various tax credit. Obviously, that goes on top of what the private sector will be doing. So we have to be careful in terms of magnitude of who's doing what. So here, the federal government is putting incentives for the private sector to invest and take advantage of those credits. Because obviously, if nobody invests, that 20 billion is probably not going to get spent. So that's the idea.
Is it smart spending, do you think? Is it a copy of the United States, or is it a made in Canada industrial strategy?
It's more of a made in Canada, because the way our structure for the incentive for decarbonization in the US and Canada works is very different. Here in Canada, we took kind of more of a carrot and stick approach. So we have the stick, the carbon tax tells people, well, if you're emitting carbon, here you have to pay a tax. But then you also have the carrots that if you invest in low carbon process, well, you get a tax credit. So kind of both together kind of incentivize various actors to invest in low carbon technology. In the US, they just took a pure carrot approach because they don't have a carbon tax. Right. So for them, that's why they had to be extremely generous in their tax credit. And the way it works also, it's a very different way. Here in Canada, we took an approach where the tax credit is on the investment. So it's when the company buys the equipment, install the equipment and all that, that's where they have the tax credit. In the US, the tax credit is on production. So you have an incentive to produce more, but then maybe at a higher carbon rather. So it's not clear which one is best. I'm not an expert in green policies, but from what I could read and hear here and there, both will achieve their goal of promoting more investment in the decarbonization of our economies.
But you didn't, yet you said that it wasn't necessarily great for Alberta. Why?
Well, I think it will be a disappointment for Alberta in terms of, I think there was a lot of hope here, because we had in budget 2022, we had a big program of tax credit, but specifically on carbon capture and sequestration and direct air capture. So I think, I don't remember exactly the number, but I think the tax credit is almost like 50% for carbon capture and all that. I think there was a hope here in Alberta, especially from the government, that the federal government will come to the table and kind of enhance those levels of, and kind of make it more advantageous, the tax credit system for carbon capture. But it didn't. What has been done instead is that the tax credit has been announced in the budget 2023 is mainly for clean energy, clean electricity. So promoting production of electricity through wind, solar, promoting the infrastructure, so the improvement of the grid, of the electrical grid. So more that section, because we know with the decarbonization, energy demand or electricity demand will increase dramatically across Canada. And our grids are way too old and not ready for that. So there are needs for massive investment there too.
Let's turn to transfers to provinces and people. I understand that a substantial portion of the budget goes to old age pension transfers and to healthcare transfers. Do you think we're spending too much in those two areas? Not the right amount of money? You and I chatted before about the benefit of transfers versus tax points and whether it was fair for different provinces, et cetera. What's your sense of old age pensions and healthcare transfers?
Oh, I'm not a specialist on the old age pension, but of course that's an area where it's taking more and more space in the budget because of the aging of population. So it's always more of an actuarial issue, is how much is it going to cost in 20 years from now when everybody's living longer and our population is aging? So it's mainly that. Is it just? It's a question. It's an issue of intergenerational fairness in some ways. Yes, the retirees have paid their tax all their lives, so they've been promised pension, but at the same time, if there's no more services for the younger generation, so there's a bit of an issue there.
I think that the line is that we are the first generation in history to spend more on people over the age of 65 than under the age of 18. So you talk about sort of an intergenerational, and is it fair? I ask you, what do you think? Is it fair?
I think for me, the question is it is it removing money for places where it could be better spent with a more broad-based benefit for the general society? And I think it goes for a lot of what we're seeing in the budget right now. Like this, we're talking about healthcare. We can talk about the dental plan that has been announced last year and that kind of again been enhanced this year. Is that it's also a question for me is that you can have social policies, but are they just cost based or do they have also economic benefit? And I think a great example of a social policy that's been put in place by the federal government in recent years that also have big economic benefit was the transfer for affordable daycare. Because at the same time, yes, you're helping providing and providing a social policy and helping people afford daycare, but at the same time, it has a very big economic benefit because suddenly you have a big cohort of the population, mainly in traditionally women in their core working age, so between the age of 25 and 55, that instead of having to take part-time work or actually leave the workforce because they cannot afford daycare, now they can send their kids to daycare and contribute to the economy and continue their skills. And then again, in the context where we have an aging population, the increase in skill set will be important in keeping as much as possible of our workers engaged and productive will be important. So that's the kind of policy that has kind of a benefit on both sides. So we have to be careful. You need more of that.
So I can see your argument on daycare. What about healthcare spending? Does that have the same argument? It seems like it's just this massive hole that we keep on shoveling more and more money into.
I think healthcare is a different animal. Healthcare, the issue is, I think there is one, it's becoming bigger and bigger and bigger to a point where I'm not sure throwing more money at the problem is actually the solution. I think at some point we might have to start thinking and rethink the system. What actually does it mean to have a public healthcare? How does it, and also, how does it work elsewhere in areas, in countries where they also have aging population, where they have similar demographic? Can we learn something from them? Because often we're not the first country to be having healthcare issues or having aging population and having public healthcare. So I think we may have to bite the bullet and actually say we need to reform our healthcare from scratch, not just incrementally.
How would you think of reforming it? I've heard a statistic. I don't know if it's true or not, but I've heard a statistic that something like 80% of your lifetime healthcare dollars are spent in the last 18 months of life, which suggests as we have an aging population that the healthcare dollars are going to go up dramatically. How would you potentially reform it?
I'm not an expert in healthcare. That I have to admit. I don't know enough about it to promote good policies. But I'm sure the thing is that there are very intelligent health economists that have been working on that their whole life. They have a view on that that's much better than me. But I think what we've seen over the past few years is that it's clear that just throwing more money at the problem is not actually the solution. So there is something else. It needs to be rethink in depth. But the issue is you need to probably get the 10 provinces together and to agree to the standard levels across the board.
We're chatting tonight with Charles St-Arnaud, the chief economist at a credit union in Alberta called the Credit Union Central Alberta, about the economy, about the budget, about what he thinks needs to be done. We're going to take a break for some messages and be back in just 2 minutes with Charles. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking about the federal budget today and the economy in Canada and what's going to happen in the future. Our guest is Charles St-Arnaud, who is the chief economist at the Credit Union of Central Alberta. Charles has got really quite an interesting education. He's got a Master's of Science in Economics from the Université de Québec à Montréal. He's got some interesting background. He has worked as an economist at the Bank of Canada, where he conducted research and built models to focus on Japan, the UK, Euro area, and China. So he really focused in on Asia and some other places. And then he was a currency analyst, currency economist with Morgan Stanley in London, England for a couple of years. And then he was a senior economist with Finance Canada, and he briefed people on unconventional monetary policy. Now that sounds interesting. I got to ask you about that and foreign exchange intervention policy. And then he went on to become a senior economist and a foreign exchange strategist at Nomura back in London, and then in New York before he became a senior investment strategist in London with a company by the name of Lombard, and then moved to Calgary to work with Alberta Central. Maybe we should talk about foreign exchange for a minute. You know, we've had a depreciation in the Canadian dollar. Is that good for Canada?
Well, as much as we are an exporter, it actually helps make our products more competitive.
But doesn't it make us less wealthy on an international economy? It makes all the imports more expensive. When we go to Florida, everything costs more. Aren't we effectively just taking a voluntary wage cut?
Yeah, but to put it this way, does spending in Florida help the Canadian economy? No. It would be better if people were spending that money in Ontario or Quebec or BC or anywhere they were. So that's the thing. Exports are actually subtract to our economic activity. So on that front, it's not necessarily a negative. Where the weaker exchange rate is a positive is, like I said, is that suddenly produce or products built in Ontario by the manufacturers are more competitive in global market because those are cheaper because they're be labeled cheaper in US dollars. So you kind of improve your competitiveness and your attractiveness of your product. Of course, there's a limit. If you drive your exchange rate lower by 100%, or you cut interest rate by your exchange rate by 50%, then it creates other issues because a weak currency also makes, as you said, imports more expensive. So considering we import a lot of goods from China, usually labeled in US dollar, if the Canadian dollar depreciates against the US dollar, then those goods are more expensive and that contributes to inflation. So it's a fine line on both sides. So in normal situation, a weaker currency helps our competitiveness, but in the current situation where we have high inflation, probably further depreciation of the Canadian dollar might not be that helpful, actually, at least to fight against inflation.
Because it would end up being more inflationary.
Yeah.
That's interesting. I think that this competitiveness is a fascinating topic. I'd love to chat with you at some point in time about it in greater detail. At the time of the Canada-U.S. Free Trade Agreement in 1988-89, the Canadian dollar was trading around par. And a lot of people thought that it would be a massive adjustment for Canada to adjust to free trade with the United States. And it didn't end up being as massive an adjustment. And I think one of the reasons why is the Canadian dollar depreciated significantly in the subsequent couple of years against the US dollars, I think by like 20-something%, such that we became cheaper and our wages were reduced. And I think that allowed the adjustment to take place more quickly. I got to ask you, what is unconventional monetary policy?
Well, unconventional monetary policy, it's becoming a bit more mainstream, and we saw it with the pandemic. It was even used here in Canada. It's everything that we call quantitative easing and quantitative tightening. So basically, using the ability of the Bank of Canada to buy in the market various assets to provide liquidity and also to ease some tensions in the financial market. So a good example, and that, like, I've been studying that since the early 2000s when I was at the Bank of Canada. I was covering Japan, and Japan have been at it since then, is that the idea is that because conventional monetary policy is that it's what we've been used to here in Canada, is that the Bank of Canada, they said, we need to increase interest rates to slow the economy and fight inflation. That's what we've had last year. Or there's a slowdown, we cut interest rate to stimulate. That's kind of the normal kind of monetary policy that we're used to at a conventional type. But once you get to a point where you've cut interest rates so much that you're now at zero, there's not much you can do. So your alternative is that then you start to stimulate by doing what we call quantitative easing. So, and we saw during the pandemic, the Bank of Canada came to the financial market and bought some government bonds throughout the yield curve. And by doing that, it reduced the yield on those instruments or the interest rate on those instruments and provide extra liquidity to the market and stimulates the economy through that channel.
So I read an interesting article a week or two ago that said quantitative easing is easy to do, but quantitative tightening is really challenging to do, and that a lot of people don't know exactly how you do it, and that quantitative tightening might actually risk some of the financial instability in banks that we saw with Silicon Valley Bank, et cetera. You're the smart guy here. Tell me, how do you do quantitative tightening? And is it a lot more challenging than quantitative easing?
Well, it's always the same. It's always easier to provide stimulus to the economy than removing it. People get used to have it to cheap money. And I think in the case of Silicon Valley, there's different things. It's not just quantitative tightening that actually didn't help. There's also complete mismanagement of risk that they bought long-term fixed income assets at the bottom of the interest of the market when actually interest rates were extremely low. But then as interest rate starts to go up, the value of those bonds starts to decline. It was basic finance 101. They should have known it would happen. There's other issues that they had. They were a bank that was catering massively to the tech sector, and they were seeing a lot of outflows from those tech industry that because they are also seeing loss in those industry and had to draw on their deposits to cover those losses. So you had deposits falling down, then they needed to sell some assets to cover those deposits, but then those assets has lost in value, and then you're like suddenly, oops, my balance sheet is no longer as strong as I thought it was. So a lot of it is a complete mismanagement, and that they should have seen coming just by having the just a finance 101 class, which is surprising on my side. I'm like, but there's a thing is that we've had close to zero interest rates in the US for almost 15 years. So there's a whole history or a whole experience with higher interest rates that disappeared. If you walk, a good example, if you walk on any trading floor in Wall Street right now, most of the people that are there have never worked in an environment where rates were higher than 5%. So it's kind of so there's a complete change of mindset that is needed, and it's a new learning curve for many of them.
Well, you probably learned more than the vast majority of people because you were at Finance Canada in a senior economist role during the financial crisis, and you participated in cross-institutional things to discuss government reactions around the world to the financial crisis. Let me ask you, you were there obviously as Finance Canada, as the government of Canada was thinking about how to deal with bankruptcies and a financial crisis worldwide. Did we do the right thing in the last couple of weeks with Silicon Valley Bank, UBS, Credit Suisse, et cetera?
Yeah.
Some people have said that this is capitalism for the poor and socialism for big banks. Are we doing the right thing?
Well, that's always the issue. I think one of the things is I think what's going on is that there's still a lot of fear of what we would call the Lehman Brothers moment, because the financial crisis really started or kind of accelerated dramatically when Lehman Brothers went bankrupt in September 2008. And there's always that fear in the market, in everyone who deals with banking, is that, are we in that case? So I think sometimes it generates overreaction, which we've seen a lot of overreaction over the past couple of weeks, people not really sitting down and thinking carefully what is really happening. So being reactive rather than taking the right decision. At the same time, you got to wonder the different things. Is that you need to be careful that like Silicon Valley Bank was classic run for bank, classic also mismanagement of their asset. The issue was, what do we do with the people who have or with the customers that had millions of dollars uninsured of those banks, because in the US, the FDIC covers $250,000 of deposits as an insurance. So if you have less than a quarter, you're 100% covered. But if you have more than $250,000, well, what's above, it's your loss. So the concern that the authority had is that, well, if those companies lose the $1 million that they have, we could see a wave of corporate bankruptcies in the tech sector that could have a snowballing effect on other sectors. So in some ways, protecting the depositor was probably the right thing to do.
But doesn't that mean that people are going to get the expectation that they'll always be covered, and that therefore, even though the FDIC guarantee of $250,000 is stated that it's limited, people say, "Oh no, they'll always cover us."
That's the issue, and that's where I'm like, I understand why they needed to support to prevent contagion to the real economy. At the same time, you also have to wonder, why, as a company, you were holding, let's say, $50 million in a bank account, giving you 0% interest, when you could have just put that money into government T-bills that would have given you 4.5% safe and liquid. You can sell 50 million T-bills in a day, no problem in the US. So it's that's where I say that a lot of people working in finance right now will need to rethink carefully what it means to deal with or to do business in an environment where interest rates are 5%. Keeping liquidity in a bank account doesn't make any sense anymore, because you can have better returns elsewhere in the market. Banks need also to take that into account. That means that their deposit can leave very much more easily. Their assets that are supporting those deposits also, as interest rate goes up, lose in value. So there's a lot of learning there, but there's a lot more. It's more of a risk management framework that needs to be improved for an era of rising interest rate, but also higher interest rates.
But then it didn't stop with just one institution. It went on to several others, including Credit Suisse, which was thought of as one of the largest, most successful investment banks.
Credit Suisse, though, I would say, having worked in finance for a much of my part of life, and especially in London, everybody knows Credit Suisse was a basket case. So it has been in trouble for the past decade. It has had its fair share of issues. I think nobody you'd speak to who has worked in finance was surprised to hear that Credit Suisse was having trouble. I think where its issue is, when a big institution like that gets into trouble and needs to be rescued, is how do you do it? So, and having it
I'll challenge you. You talked about the Lehman Brothers moment. I worked on Wall Street. I went and talked to different investment banks on a fairly regular basis, maybe not as intensely as you, but Lehman Brothers was before Lehman Brothers was Bear Stearns in I think it was March of 2008. And Bear Stearns was always thought of as overly aggressive in the marketplace. Lehman Brothers was certainly thought of as overly aggressive, and they went 1-2. And then the big, what was it, AIG, the big insurance company, almost teetered. Goldman Sachs almost teetered, and they were saved. And Credit Suisse versus UBS, the other big Swiss bank, was always thought of as more aggressive versus the less aggressive, a little bit more conservative UBS. But it didn't stop at just Credit Suisse. Yeah. There's a lot of different financial institutions that have been thought of as pretty aggressive.
Yeah, but we cannot compare the current situation with 2008. Like in general, if you look at the balance sheet and all that of most investment bank in 2023 versus 2008, they're very different animals. They're
so you're not worried that this is going to go further?
There'll be further tensions. Are we going into a financial crisis? I have my doubt.
Okay, so if it's not going to go further, why did we have to save the first couple? It wasn't a Lehman Brothers moment then.
Well, like I said, Silicon Valley Bank was mainly more of an issue of contagion to the real economy, because they were very much concentrated in one sector, and you would have seen a wave of corporate bankruptcies with big issues and big spillover. in a very concentrated area. So I think that's where the intervention was required. Credit Suisse was more that it's more that you don't want to let a big institution like that fall completely, like we saw with Lehman. Bear Stearns was the great example. Bear Stearns was actually, I can't remember who but Bear Stearns, was it Citi? I don't remember, but a lot of the early one, they one of the bigger one of the more healthier institutions came and kind of swallowed them. So, and that's basically what the idea was, is that instead of leaving Credit Suisse to go completely bankrupt and generating, that would have been when you would have had more issues, because suddenly it's like, okay, who's on the other side of the trade? Who's having the loss? So you'd have, rather now you'd have, well, okay, you wipe out shareholders of Credit Suisse and you merge it with a safer and healthier institution. But it's a forced marriage. I'm not sure UBS is super happy either to have to be forced marriage with the Credit Suisse, with a culture that's very different from them. UBS has always been, at least in Switzerland, their big bread and butter is wealth management. They're one of the biggest wealth manager in Europe. They barely do anything in investment banking, and now they're getting that kind of more Wild West investment banking institution that they have to swallow. So it's not going to be cost free for UBS.
So you worked in currency, foreign exchange currency predictions. The Canadian dollar is down. Would you recommend people buying Canadian dollars, taking money out of international currencies and putting in Canadian dollars and expecting the Canadian dollar to appreciate?
It depends against which currency, because it's always hard to talk about the Canadian dollar as just pure Canadian dollar, because exchange rate is always, it's a relative price. It's the price of a Canadian dollar versus another currency. So if we look at the cross that matters the most for most Canadian is against the US dollar, I think we'll see a small appreciation in the Canadian dollars in the coming year or so, but it's more coming from slight depreciation of the US dollar as some of the tension in financial markets get removed, as the Fed is gradually signaling that they're done increasing interest rate. As I'm going to be surprised that we'll start to see higher oil prices coming up later this year. That could provide some support for the Canadian dollar. So that's probably it. But is it a big appreciation? I don't think so. I think we're just going to be roughly slightly higher than where we are, but not by much.
What about the euro?
The euro, we've seen a lot of people being worried about the euro because of the Credit Suisse issue. International investors, for some reason, always are quick to jump on the bandwagon that the euro or the European banking sector is going down. And I think it's more experience from the early 2010s when we have the European crisis and tensions in the banking sector post financial crisis. So I think we could see some appreciation in the euro, especially considering how weak it had been recently.
What about the British pound?
British pound is picking up. It already picked up a lot because we've had those issues with the previous government last fall when they announced a budget that was completely dismissed by the financial market, and we had the pound collapse. So now gradually you're seeing a reappreciation, and it's more because the current government is actually putting economic policies that are a bit more but probably better in general for their economy, but they still have some big issues. Inflation in the UK is still extremely high and without signs really of coming down. So at the same time, you have the Bank of England will need to increase rates probably much more than we're seeing in Canada and the US. So that could provide some support for sterling.
So you talked about how the financial market reacted so negatively against that budget in the UK back last September. The financial market sort of responded positively to the Canadian budget. Does that mean that Chrystia Freeland's doing a good job? Justin Trudeau's doing a good job?
They're doing an okay job. Again, it could be worse. It could be better too. It's the thing. It's always related. It's always also related to what we're seeing elsewhere. So in that, like, criticize the budget that it's a slippery slope. They could have done better. They could have more a better anchor to bring a balanced budget over the projection period. But then you compare yourself to the US, where fiscally it has been a mess for years. Same in Europe. When we compare our debt level in Canada, our government debt level compared to other G7 countries is in much better shape. So yes, if we compare to everyone else, we're doing better. But when we look at our numbers, it's like we could actually be. It's not looking great.
We're chatting tonight about the economy, about the federal budget, and what came out and whether it made any sense. Our guest is Charles St-Arnaud. He is the chief economist at the Credit Union Central Alberta. He's got quite a background with Finance Canada, in investment banking, in foreign exchange, and he was at Finance Canada probably during the most interesting time one could think about being at Finance Canada during the financial crisis. Fascinating conversation. We're going to take a break for some messages and come back with some concluding comments from Charles in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Dr. Charles St-Arnaud. He is the chief economist at the Credit Union of Central Alberta. He has got a long pedigree with different investment banks, with Finance Canada, chief economist, etc. And we've been talking about the federal budget. We're talking about the economy. We've been talking about interest rates, and we've been talking about currencies. Charles, we've got high inflation in Canada. We've got high interest rates. We've got anemic growth in GDP. We've got no real growth in real per capita incomes. We got no increase in productivity in the last while. We're a sorry state, aren't we? What if you were Chrystia Freeland, our Minister of Finance? What would you do?
Oh, that's a good question. It's easy to comment from the sideline what's going on. But of course, I think one of the things that's for sure, when we look at the situation with high inflation, it's not the time to increase spending. We should be a bit more careful on how we spend. I think spending more on programs that help our productivity, that entice businesses to invest, is probably where I would go, because as you mentioned, our productivity in Canada is very weak. Our GDP per capita is going nowhere. So we need that increase in productivity. We need to generate our future wealth and to increase our potential growth. So that's where I would put more of the attention. But unfortunately, that's always easier said than done. We've known that this has been a problem in Canada for years, and yet we're still, well, I remember when I was studying economics more than 25 years ago, it was already mentioned as an issue. So 25 years later, we still have the same problem. So it's not as easy to solve, but I think there's more and more of an urgency there, especially as our economy is getting older every year.
So how do you increase productivity? You know, we had a book that came out by our former Minister of Finance who said that we didn't have a growth agenda. We didn't have a prosperity agenda in Canada. If you were in charge, what do you do to increase productivity?
Well, I think he's right. One of the issue we've had over the past 30 years or so is that when we look at investment numbers, most of the investment in Canada has been going into housing, while business investment has been declining as a share of GDP. So you have to start asking your question, because obviously investment in housing is important because people need a place to live, but it doesn't bring any new production. It doesn't increase productivity. So why are businesses, or the investment in businesses, is going so low? Is it an issue of lack of opportunity? Is it an issue of funding? Where actually, and you see it in banking data, lending for mortgages is taking a greater share of their assets than lending to or growing part of their assets versus lending to businesses. So is there an issue where our financial system kind of promote the whole residential sector and hinder business investment? Is
But
there
if
that?
housing pricing was going up at you've seen the same numbers that I've seen at something like 3 or 4 times the rate of inflation. So I think the rate of inflation in the general economy over the course of the last generation has been low single digits. And I saw a statistic that showed that the rate of inflation in housing prices was in double digits, and so it was dramatically higher. And so if you could lend money and you didn't have to do anything smart. You just had to wait for inflation and appreciation in house prices to pay you back. That's probably an easy bet. So that's not financial smartness. That's just inflation in house prices.
Yeah, or even for bank, if you have to lend someone $500,000 and it's guaranteed by a house that's increased in appreciation, or lend that $500,000 to a business that could fail in a year, it's easy choice for a bank. You have a much safer lending book if you lend to a appreciating house. So, but that's the thing, is that we had some economic factors that were implying that. So, but can we, in some ways, and that's why I think there's not enough discussion in Canada, is can we actually find a reason why businesses are not investing in technology, in machinery and equipment, in research and development? Canada is doing extremely badly in investing in research. So obviously that means that innovation is not there, and innovation is productivity.
So I come back. If you were the Minister of Finance, what would you do? Put in big tax incentives for investment in innovation and productivity and research and development?
The question is always, is it really just need to be just the government, or it's a national discussion? Because it's not just the government's role. There's also the part of, as I said, how does it get funded? Can we entice banks to fund more, or financial market to fund more the investment in research, investment in technology?
I've tried to raise money for pharmaceutical companies, for tech companies, for alternative energy companies. It's challenging in Canada. One of the reasons why it's a lot easier to put money into real estate and or oil and gas.
Yeah, I completely agree. And that's it. And that's an issue, is that we have to get better at making sure that there is money for other sectors. So again, maybe the solution is more government incentive. It's always the question is, how much does that cost? Can we put different tax structure to force or to incentivize banks to be more willing to invest in those and to lend money, or private investors? Because obviously, you don't need just to have banks as loans. You can also have private investors. We have massive pension funds in Canada and asset managers that would be more than happy to invest in other things if they had easier ways. Or hey, even the savers in Canada, like you can have easily funds that actually can do kind of more kind of private equity type funds, but are owned by individuals rather than being good. So I think it's that kind of thinking, is trying to, can we find better solution to fund those sectors? And your comments that it's hard to raise money for a lot of investment, it's not the first time I hear it. It seems to be a common thread over the past 10, 20 years in Canada, and yet nothing is being done.
Nothing is being done. Okay, Charles, given this conversation, given the challenges that we're faced with, if you had to give an A, B, C, or D, or F to Chrystia Freeland and the budget last week, what grade would you give her? A plus?
No, it wouldn't be an A plus. I would say probably kind of a B minus to a C.
A B minus to a C.
Yeah, it's like it's a passing grade, but it's not a great passing grade. It could be better.
Charles St-Arnaud, the Chief Economist at Credit Union Central Alberta, thank you so much for joining us again and sharing with us your thoughts on the federal budget. the C passing grade. I appreciate that. And I do think that we've had a good conversation about the financial challenge, both in 2009 that you had that experience, but what its applicability to today is, and also the challenges of productivity and what we're going to do in Canada today. So thank you for sharing us your thoughts in that regard. I remind you, everyone, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online, even from Alberta, at www.saga960am.ca. My podcast and videocasts are available on my website, briancrombie.com, Facebook, Instagram, YouTube, LinkedIn, and all the podcasts are available on a whole bunch of different places where podcasts are available. Charles, thank you so much for joining us again.
Thank you for having me.
Good night, everybody.